Is Larry Shover, Chief Investment Officer at SFG Alternatives in Chicago. Larry, great to see you there. Now, just in terms of the oil price slipping today, all on rising stockpiles or expectations of rising stockpiles. Obviously, you know, the OPEC meeting last week, that's provided a lot of positive momentum recently, but there are still warnings, a lot of caution about the supply overhang that still remains in the market.
Yeah, and that's been the story for a while. But right now, you know, the call to action from OPEC is just outweighing fundamentals. And that's something that we've talked about all year, that fundamentals seem to take a back seat to the headlines. So right now it's all about production cuts. And I think what people are reading between the lines with OPEC is that perhaps they've just given up and realized that the fundamentals are deteriorating ever so slightly with regards to supply and demand dynamics, and it makes more sense for them to do what they've called to do. So I do believe that we're going to see a retracing in oil prices because it does tend to overshoot on the upside and the downside, but who's guessed when that will happen? I know WTI basically belongs in the low to mid 40s right now, given fundamentals.
Larry, do you expect the commitment to cut production will be honoured at the November OPEC meeting?
I personally do not think they will. I think there's too many moving pieces. This type of thing has been broadcasted years and years and years in different ways, and I think it's just too hard. So, no, I don't think so. I'd be welcomely surprised if they did. All that to say, if they do this, and they do cut production, obviously my price targets for next year will be much different than they are right now.
All right, let's get to the broader session today, and I just wanted to get a thought from you. At the moment, I mean, reading some comments, there seems to be two schools of thoughts. You know, you've got these momentum traders, which seem to be buying the dips, but then, of course, you've got the rising dollar and the view that it could keep going, which is very much weighing on the market at the moment.
Yeah, exactly. I mean, this is interesting to see the dollar rally 2 days in a row, basically on just the changing commentary. Finally, the market's waking up and realizing that monetary policy has evolved, and the markets seem to be behind that, no matter whether you look at the equity market, currency market, gold market. And today seems to be a reaction to that. It's not so much Brexit or Deutsche Bank or anything else. I think it's just worldwide growth, or nominal growth, as it were, just allowing the risk-on mode in different areas, but also seeing things like the S&P 500 not being able to break through that high and it's faltering back into that range. Gold drops as much as we've seen it, and the dollar rallies 2 days in a row.
Yeah, well, I guess it does all relate back to the Fed with those rising interest rates, meaning that dollar is rising, and then obviously the commodity complex tends to lag there, and that's obviously what we have seen with those oil prices. But the sell-off with gold, you know, mainly due to the Fed making noise about the November meeting as well, that could be live. We heard those comments from Loretta Mester, but quite interesting given the US election is happening in that month, only a couple of days away from that meeting by the US Fed. I mean, it's probably unlikely the Fed's going to combine two of those risky events in 1 month. Would you agree?
Yeah, I would agree totally. But I do think the Fed was explicitly clear that they want to raise rates, and unless we get something crazy like the next three jobs reports that we have come out to be like sub 150,000 or sub 125,000 even, they're going to raise rates, and I think they're gearing the market up for that. I don't think the market's prepared for a Trump victory, but I don't think the odds of Trump winning right now are very good anyway. So I agree with you. I can't see the Fed doing anything sooner than December the 4th.
Just whilst we are talking currencies, I wanted to ask you about sterling, still hovering around those 31-year lows. And I think there were a lot of currency investors that were hoping that the UK would be able to negotiate some sort of special deal, but calling for this March exit seems to have really caught people and caught the market off guard.
Yeah, you're exactly right. It's amazing when that happens. So often the markets kind of move before the data says so. And here's a good example that markets just caught flat flat-footed. And we saw how much the pound dropped today against the U.S. dollar. And, you know, this divorce proceeding between Britain and the Eurozone, it's going to be a lot more complicated than first advertised. And it's going back to the issues of late June when people thought the worst was to come. It probably won't be anywhere near as bad as people first thought, but it's going to be a lot more complicated. And we're seeing something very similar in Japan, with the Bank of Japan keeping a watchful eye over the yen. And that was another, you know, a big reason for that weakness in the yen versus the dollar today.
Now, Larry, I note that you say, I was just reading your note earlier, that the big overhang at the moment isn't so much some of these discrete macro issues, the likes of Brexit, Deutsche Bank, of course, financials, you know, US election uncertainty, but instead the evolving monetary policy backdrop. Take us through what you mean by that in terms of the implications on global growth and so forth.
Yeah, no, I think, like, at least in the U.S., they made it clear that they want to raise rates, and they will raise rates as far as I'm concerned in December. Perhaps purchases on the ECB will stop and taper. At least tapering will be in the headlights far in the distance, but stop printing money, stop easing. So at least tapering is not tightening, but they're not going to be loosening anymore. And then we also have the Bank of Japan, major bank that's looking more at the yield curve than it is at asset purchases. So it's a point now where do these central banks have more ammunition? Of course they do. They always have something else that they can connive and put together. But at this point, I think they realize that they just cannot continue in this loosening stage. And so the market has awakened to this and is kind of resetting as we speak, given the slight rise in nominal global data.
Well, it seems to be more a case of local uncertainty and global stability at the moment, isn't it? I mean, do you see any potential shocks in front of us that might break this sort of relative quietness at the global level?
Yeah, exactly. And it's something that's taken me years to figure out. And it's like, you know, back in 2008 and so on and so forth, everything that happened had such a chain reaction, such a domino effect everywhere. But recently, you think of some of the local instabilities and how they really haven't had the same opportunity to impact the global market. And I was spent the last 18 months scratching my head and say, well, look, why aren't we breaking due to what's happening somewhere else? But I think the banking system in general is a lot more shored up than it was in the past. Firewalls are much better than they are, and banks largely are better capitalized, keeping local instability local.
All right, fantastic, Larry. We'll leave it there. Really appreciate you joining us. Thanks very much.
Thank you.